Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors, and I have some awesome hosts I have an awesome host, obviously, always in my studio and on my show, Mr. Tony Shore. But Tony, we have an awesome guest with us as well today. So, viewers, you can already see him, and you're like, "Oh my gosh, there he is again! It's that Tyler Ellegard guy, the portfolio manager from Gradient Investments." And of course, my listeners, now you know the cat's out of the bag. Yeah, we're very fortunate to have Mr. Tyler Ellegard as a guest on our show again today. So, Tony Shore, good morning. Happy Monday. Tyler, good morning. Happy Monday to you as well.
Happy Monday.
Happy Monday. Thank you so much, Jason, for having me on the show once again. And Tyler, I'm excited.
I need to come back on the show more because you guys really pumped me up here.
Well, you're a huge guest.
I like this.
Very
well, it's awesome.
Portfolio manager.
Yeah, I mean, it's awesome when we can have you, Tyler, either yourself or another member of your team. Because Tyler, for my viewers and listeners that don't know, Tyler Ellegard is a portfolio manager for a portfolio managing company, Gradient Investments, who builds and manages portfolios for clients on a Charles Schwab platform. Now, that sounds all crazy. Well, talk about behind the trenches or in the trenches, right behind the scenes. So when we get a chance to talk to people about where should I be invested or where should I not be invested? Or, gee, is the market going to go up or down? Or what's going to happen with gold or with AI and with interest rates? And a lot of that stuff, you got to have some real big players behind you to be able to answer those questions with confidence, right? To comfortably give a good answer. And that's why we have our relationship with Gradient Investments like we do, and with Tyler and his team. They're awesome. They're absolutely just amazing as far as people go, as far as awesome humans, and even more awesome and phenomenal portfolio managers. So as you and I know, Tony, we talk about all the time, like who can we have as a guest on the show? And we always throw big names out there. We always try to really go after some awesome guests. And we've had quite a few of them. We've had Cora here in town talk about, Medicare and health insurance. We've had Carissa Milholland talk about estate planning. We've had Tyler from Gradient Investments, a couple of the portfolio managers. And it's just awesome when we can have these types of resources to bring this added value to the table for all my listeners and all my viewers, as well as the clients we serve. So again, Tyler, thank you so much, man, for everything you do for Gradient Investments, for everything you do for the investing community in the United States, and everything you do for us and our clients. And thanks for being on the show again.
Well, I really appreciate having me on again.
Yeah, you're very welcome. So, Tony, I know we always start off the show by just kind of catching up with what's been going on in our lives personally. How's the family? How's the kids? I know, Tony, you've been doing a lot of traveling. You do a lot of traveling, not only for your family, but you also travel the country going to other advisors' offices and doing local events at their offices in their towns for their clients, as well as radio shows when you're on the road. So bring us up to speed on what's been going on with you the last few weeks.
Well, and it's somewhat work related, but I usually manage to work in some fun. I recently met with one of our advisors from the Wisconsin Illinois border there.
Okay.
And he happens to be a big Bears fan. And he's like, you got to come down, see my office, and then I'll take you to the Monday Night Football game, Bears versus Vikings. So I was in Chicago last Monday and got to go to the game. Of course, great finish for the Vikings fans of that game.
Great finish, yeah.
He was kind of head down, after the game.
Did you have to walk home or take an Uber? Because I guarantee you didn't get a ride in his car.
No, we walked. He actually was staying in a hotel downtown.
Okay.
So he didn't have to go back out to his office. He's not right in Chicago, but he's more on the Wisconsin-Illinois border. But
okay,
he's a Bears fan. But we stayed within walking distance down there. We did walk back to the hotel with him and all the fans, and it was pretty funny because it was quiet. Because there were a lot of Vikings fans there, and they were just kind of silently fist bumping each other and smiling. And all the Bears fans had their heads down after the game because they lost, in the final minutes there. Mm-hmm. But what was funny is there's thousands of people because the Soldier Field is in Grant Park, and you have to walk through these tunnels and through the park. And everybody pretty much goes the same direction. So you're talking about thousands of people. Everybody's packed in walking. And it was quiet after that game. And I think it was a bunch of Bears fans. Somewhere in the crowd, they started chanting Packers and then SUCK. And the whole crowd, the whole way, was chanting negative chants about the Packers.
Yeah, well, that's awesome. That brought both groups together. Brought the Bears and the Vikings. Brought everybody. Yeah.
It brought everyone together. It even Detroit fans, had they been there, would have gotten in on that chant, I think.
Well, and I'm glad to hear you say they were talking about the Packers and not saying the Lions.
Oh no,
SUCK, right? So I'm glad you guys picked on the Packers. That to me, I'd get in on that chant with you as well, Tony. So.
Oh, I'm sure. We laughed. My wife and I. My wife went with me on that trip. We were all laughing so hard because it's like it was so quiet, and all the us Vikings fans wearing our Vikings.
Yeah, you wanted to celebrate, but you want to be very quiet, very respectful about it. You didn't want to cause any problems.
Yeah. But the Chicago fans were great. I mean, I've been to. I'd never been to Soldier Field, but the Bears fans are great. I think they're good fans, as are Detroit fans, as are Vikings fans. We're not going to comment on the Packers fans or Philadelphia, are we? We're not going to talk about that.
No, I don't think so. No, there's a different time and a place for that, and my show is not the time and place. So.
No, so I have been traveling quite a bit. Nashville, Columbus, Ohio, Chicago, and now I'm going to New Orleans. So hopefully after that, I'll be done traveling for a while.
Yeah, that's a lot of travel. Now, are you going to be participating? I know a very large elite advisor conference is happening this week out in Minnesota at Gradient Investments headquarters as well. Are you going to be there to attend that, or are you going to be traveling?
I will be in New Orleans. It's the first year I'll have missed the Elite Advisor Forum that Gradient Investment sponsored. They're going to have Brian Belsky, the key guy, the key investment strategist for BMO. A lot of great minds. Top advisors. You're usually there. You have some family stuff this year, Jason, that you usually are there imparting your knowledge. But Tyler, I bet you're going to be there this year, right?
I am. Yep.
And Belsky's going to be there this year, right? From BMO Bank. Yep. He's great. Yeah. I love Brian Belsky. One of the sharper minds in the overall financial and investment world. Between him and Tyler, that's a must go to event, right?
That's a full house. I mean, that's a full show right there. And you're right. I'm usually there. I think this will be the first year since Gradient Investments has held this Elite Advisors Forum where they invite their top 100 or so advisors across the country. I did get an invitation this year, but it'll be the first year that I have to turn down the invitation. I'm not able to make it just because a lot of family stuff going on with Lexi going off to Michigan State. And it being homecoming for Josie and Carson back at Meridian. And so just logistically didn't work out with travel plans, but I'm going to miss it for sure. I love it watching all the guest speakers, taking in all that knowledge, whether it be speakers, like you mentioned, Brian Belsky from BMO, whether it be Charles Schwab speakers, fund manager speakers, ETF manager speakers, industry-wide, just awesome people. Tyler usually is on stage with him and his team. So I'm glad, Tyler, we're able to have you here on this show this week before the big week gets kicked off, because I know you're crazy busy getting ready for the big Elite Advisor Forum. So again, thanks a lot, man. This is awesome to have you on the show. Gonna miss you. I wish we could be there. But I know you're also, I don't know if you know, Tony, but it's really, really cool this fall. We are doing, again, what we call our State of the Economy and Market Update, which is a live event I've done for my clients for, I think, about the last maybe 8 or 10 years. And I always have an industry, in the trenches industry speaker come speak at this event, sometimes multiple speakers. Last year, we were very fortunate to have Mr. Tyler Ellegard himself, who's on the show today again. He was our guest speaker last year, and it went over so good. We had about 140, 150 people there, and it was a very high demand to get Tyler back. So I reached out to Tyler a few months ago, said, Tyler, you had a very awesome event last year when you came to see us. Very, very well taken in by all my clients. They love hearing you speak. And you're on high demand, man. They want you back. Is there any possible way you could come back and speak again this year? And so Tyler was able to do some things in his calendar to make it work out. So Tyler, I can't wait. I think it's first week of October. Tyler will be here in Midland in my office for some one-on-ones with myself and my team. And then we're doing an event at the H Hotel in downtown Midland. So any of my listeners or viewers, if you'd like to come see Tyler speak live, please call my office. and find out the details of that event and see if we can get you in. I'd love to have some of the viewers and some of the listeners from the radio show come on down and watch Tyler, and you can shake his hand, you can ask him some questions live. It's going to be an awesome event. Usually there's 150 to 200 people there, so it is a packed house. But so let's kind of jump right in, I guess. I want to kind of cover what we're going to talk about in today's show before we have to take our first break, Tony. Tyler's going to bring us up to speed, obviously, on what I call in the trenches or behind the curtain, right, behind the scenes. Because there's a lot of noise. There's a lot of rhetoric out there that we can hear, whether we turn on the radio or the TV, or we watch different like social media, Facebook, whatever that might be. We always hear different things like, ooh, gold is high, or oh, I got to go buy gold, or ooh, AI this, AI that, or gee, the Feds are going to raise or lower interest rates, and oh, the stock market's going to crash, and real estate, all these things, right? And these are all just noise that we hear out there. It's really tough for us to kind of compartmentalize what does that really mean, and behind the scenes, what type of impact, positive, negative, or neutral, might that noise or that rhetoric have on the stock market, on our markets, on our economy? Because ultimately, that's the type of impact it could have on our money, right? On our portfolio, on our 401ks, our Roth IRAs, maybe our retirement income. So it's really cool, again, when we can get in the heads of those that are in the trenches and behind the curtains. And that's, again, Tyler's going to talk today about the Federal Reserve. We have some Federal Reserve meetings coming up yet towards the end of this year. We have some thoughts or ideas what might happen, but we're going to hear from Tyler really what he thinks reality is that could happen, and maybe the implications or fallout or positive or negative of that. We're also going to get into a lot about AI today. You can't turn on the TV, you can't do anything. You can just walk out to the mailbox and have a discussion with the Amazon delivery guy that doesn't bring up AI, right? AI is everywhere. So we're really going to get into what's driving the market and maybe some positives and negatives about the future of AI. And then gold. Gold is at all-time highs. And so we're going to talk about the whole buy low, sell high strategy. We're also going to talk about not only where has gold been, but the current state of gold, maybe the future outlook, and then the overall volatility of not only gold and other precious metals, but the overall economy and our markets moving into the fourth quarter of 2025. So before we take our first break, Tony, Tyler, anything else you want to touch on?
No, I think that's perfect.
I think that's great.
Are you ready for that, Tyler? Does that sound good? Are you ready?
I'm ready.
All right.
Awesome.
Well, I can't wait to get into it, into the heart of the matter here with Tyler today. So we're going to take our first break. But before we do, I want our listeners to know that they can call in, set up a no charge, no obligation consultation with Jason and his team there at Great Lakes Investment Advisors. All they have to do is call 989-835-7203. If they have questions about what they hear today, want to see if they can get in on that state of the market where Tyler will be speaking in person there. That's a great event. Call 989-835-7203. And you are listening to your Financial Empower Hour. I am your co-host, Tony Shore. I am here with our host today, Jason Cryderman, and our very special guest, Tyler Ellegard from Gradient Investments, a portfolio manager there. So, Jason, let's dig into it. What questions do you have for Tyler? Where do we want to start? There's a lot to talk about.
Yeah, there's a lot going on. There's a lot to talk about, as I mentioned there in the last segment. What we want to really try to do for all my listeners and viewers out there is we want to take some of all this noise and this rhetoric and maybe the water cooler talk or the Facebook, whatever you want to call it, right? There's a lot of stuff we can see and hear out there. And so we have a special guest on my show today, Mr. Tyler Ellegard, who is a portfolio manager for Gradient Investments. Gradient Investments is a third-party wealth manager. They build and manage portfolios. Right now, I believe, Tyler, correct me if I'm wrong, but I believe you guys are managing north of $7 billion of assets for clients on the Charles Schwab platform, for clients of mine and other fiduciary advisors across the U.S. So this isn't somebody who just like woke up yesterday and said, hey, I'm going to manage a few $100 in the market. This is a huge company. They're very, very good at what they do, and they have very awesome people behind the scenes. And so Tyler's going to talk to us today, and help give us some maybe clarity behind some of this noise and rhetoric we're hearing out there. So let's jump right in, Tyler. Let's start off Let's start off talking about the Federal Reserve, right? That's a big deal. Let's talk about what the Federal Reserve has done this year so far with interest rates, maybe what they haven't done, what we thought they might. And then let's talk about what we think they're going to do here coming up into the next couple meetings and the impact that these changes or lack thereof may or may not have on equities markets, bonds markets, those types of things.
Yeah, perfect. So the Federal Reserve, they have two mandates, really, or key mandates, I should say. They have some other, but not really focused on those. But number one is full employment, meaning have as many people employed as possible. And then number two is stable prices, right? And so we think back to 2021, 2022, we had heavy inflation, upwards of 9% at one point. And so the Federal Reserve controls what we call the Fed funds rate, which is the benchmark interest rate that the Federal Reserve uses to either try to cool down the economy if it's running too hot, or get it moving again if it's going too slow. And so when they raise interest rates, they're trying to slow the economy. And so that's what they did in 2022 when we had 9% inflation, because coming out of COVID, there was so much demand and so much pent up money for traveling, goods, eating out, right? So there's a lot of demand for a lot of things. And if you have too much demand, the only thing that can happen is either the supply goes away, you run out of that good, or raise prices and capture that extra demand, right? And so that's what happened in 2022, 2021. We saw prices rise pretty dramatically. And so the Federal Reserve increased their benchmark interest rate to try to cool that down a little bit. Because if you think about if you have money on a credit card, if you're borrowing money, the higher the interest rate, the more you pay in interest, which tries to slow people down from taking out that loan, right? So end of last year, so 2024, the Federal Reserve started to cut interest rates because we've had ultra low unemployment rates right now. So back then it was in that 3.5 to 3.7% range, which is almost historically low. And then you had inflation coming down from that 9%. We were sitting around that 3.5% range. And so for the Federal Reserve, they don't need to keep the economy so tight by having interest rates really high. And so they started to cut those interest rates. And then coming into this year, they paused, right? They said, we're going to be data dependent. Everything seems to be running fine right now. Unemployment rate's still low. Inflation rate is coming down. So we'll just pause here and see how things go. And we'll try to keep it at this nice, steady pace that we're at. Now, as we think back to what our call was at the beginning of the year was, yes, the Federal Reserve was going to pause, but in the back half of this year, we were going to start to see some consumer weakness. We were already starting to see some cracks at the end of last year, which is partly why, also part of the reason why the Federal Reserve cut. But our call was that coming into the back half of this year, we were going to see 3 to 4 interest rate cuts. And the reason being is we're going to start to see that consumer weakness. And when I say consumer weakness, I mean spending is slowing, discretionary income is starting to dwindle because you've had inflation, you've spent down your savings. And so consumers aren't going to be buying as much or doing as much traveling. And so we've started to see that at the end of last year and throughout this year. And you've started to see it snowball higher up in the income chain, if you will, or income cohorts. So a good example of this is Dollar General, Dollar Tree. Those dollar stores are Five Below. They've started to see an increase in consumers who are making $100,000 or more, which is not a typical thing of a consumer that is making that kind of money. They continue to shop at the Targets, the Lunds and Byerlys, the higher end grocery chain or stores, rather than going to the Dollar Tree or Dollar General. And so you're starting to see that trend a little bit more. And we heard that in the last quarter report from those companies. And so you really are starting to see that tightness on the consumer increase in the income cohorts. And so the Federal Reserve has obviously been watching this, but on top of that, the United States is no longer creating as many jobs as we once were. So last month, the expectation was that the U.S. was going to add 73,000 jobs in the month of August, and we only added 22,000. And then the next week, there's an annual revision that comes out for the Bureau of Labor statistics that they released to say, do we need to revise these job numbers that we created jobs over the last from March to March. So March of 2024 to March of 2025, it gets released in September. And so that was revised down by 911,000 jobs, which is the largest revision since 2008. So we're seeing consumer weakness, and we're starting to see labor market weakness, right? If you're not creating as many jobs, your wages aren't growing as fast, that leads to additional consumer weakness. And it's not a bad thing. It's just it's what I would call a softening. It's by no means a recessionary sign. I would not say that. We need to watch it, but it's just showing that our economy is slowing because the Federal Reserve has continued to remain what I call tight, meaning high interest rates. And so they have a meeting in 2 days from recording this on a decision of, do they continue to cut interest rates that they started last year, or do they still just be on pause? The expectation is that it's a 98% expectation now that they're going to cut interest rates by 0.25% next meeting. They have another meeting in October, and there's the expectation that they'll cut by 0.25% there. And then it's a 50-50 chance right now based on expectations. I think it's a little bit higher that they'll cut, but just call it 50-50 for all intents and purposes, that they'll do 0.25% in their December meeting. So, again, our call was 3 to 4 interest rate cuts this year. So we may be getting that because of consumer weakness and labor market weakness. And so what I find very interesting, and I'd be curious your thought on this, but we got the jobs report that came in much lighter than expected, and the stock market rose on that news, right? Which is a weird thing, right? Bad news means good news for the stock market. Well, again, I said labor market softening is not necessarily a bad thing. We're still adding jobs. We're not adding it at the same exact rate we were, which means our economy is slowing down, which means the Federal Reserve at some point needs to cut interest rates to try to spur that growth again, or keep it from getting into that negative territory. And so when interest rates come down, that is good for the stock market. It is good for companies who are borrowing money, because it means that the money that they maybe financed last year, they can refinance that now at a lower interest rate.
Sure, absolutely.
And more profitability for that company. Or they can use that money elsewhere for research and development, certain capital expenditure items, whatever it might be, but it frees up additional money for companies. So that's why you see that type of reaction. Now, if the number came in negative or very, very I'll just leave it at a negative number, I think you get a very different reaction from the market, because that shows declining economy, right? So there's two different types.
Softening versus declining.
Yeah. Which is why the market did rise on that news.
Because that meant that interest rates would most likely be lowered, and that's why the market went up. Not that there was bad news in the jobs market, but they knew that would force the Fed to finally lower rates again some more, and the market wants those rates lower so businesses can borrow, or like you said, refinance, right?
And then even from the consumer standpoint, so the lower you have on a federal funds rate, the 10-year treasury, typically there's 120 basis points, or a 1.2% difference between the federal funds rate and the 10-year treasury. And why that's important is the 30-year mortgage is based on the 10-year U.S. Treasury interest rate. There's another spread on top of that for the mortgage rate. But if your federal funds rate is lower, hopefully over a long period of time, that brings the 10-year Treasury interest rate down, which then also brings your 30-year mortgage rate down. And then now we start to see this unlock of the housing market, which accounts for a pretty significant size of our economic growth as well. So you have all of these things that the Federal Reserve can do or spur by just reducing that interest rate. So that is really why the market likes having the Federal Reserve cut interest rates.
Yeah, no, that's awesome. That is, I mean, again, in the trenches, right, behind the scenes stuff that a lot of us might not think and hear, think or know, or even be able to conceptualize or put together. So when you can do this for us. Now, I do want to point out for my listeners and viewers, what Tyler said was the Fed Reserve is having their meeting in 2 days. That's 2 days from when we're recording this show, which is actually Monday. You guys are seeing this show at least Sunday or after seeing or hearing this show. So you might be thinking, well, wait a minute, the Fed's already had their meeting. What are these guys talking about? So I just want to set the stage, up right there for all my viewers and listeners that when we're recording this show, before you hear it, the Feds haven't had their meeting yet. Now, by the time you hear and see this show, yes, the Feds will have had their meeting. You'll either be able to say, yep, Tyler was spot on, man, that guy's good. Or you'll be able to say, Tyler, 2 days before their meeting, you didn't do it.
That's what I'm here for, to put myself out there.
And the rest of his team, there is nobody in this world that's absolutely perfect when we think about what might somebody else do, like the Fed Reserve, and what might stocks do, and what might the market and the economy do. But I tell you what, when you can get the insight like Tyler and his team has, where they can tell us if and when these things happen, this is what it means to corporations, and this is what it means to consumers. I think that's huge. I really do. And so I know we're going to take a quick break here. When we come out of this break, I want to pick up back in this segment. There's a couple things I want to comment and question on, and then we're going to jump into some AI.
All right. That sounds great. Thank you, Jason, and thank you, Tyler. Some great information there. Listeners, if you have questions about this, or you want to get a no charge, no obligation consultation set up, or a copy of Jason's book, Empower Your Retirement, all you have to do is pick up the phone and call 989-835-7203. That's 989-835-7203. Or you can just go to GreatLakesInvestmentAdvisors.com and fill out the contact form. There's a lot of great information on the website. Again, that's GreatLakesInvestmentAdvisors.com. And we're back with your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with Jason Cryderman, our host, the man with the plan that has the answers to your financial questions. And today on the show, we're getting a market update and an insight into certain aspects of what's happening out there. Tyler Ellegard, portfolio manager at Gradient Investments. So what do you think so far, Jason? Tyler's had a lot of great points, right?
Yeah, he really has. I mean, if we just think about the basics, right, of what drives the market, and Tyler and I have talked about this off the show. We've talked about it one-on-one conversations on the phone. We've talked about it in my office. We've talked about it in his office at Gradient Investments over there in Minneapolis, Minnesota. We've talked about it with clients of mine. The market is driven by really two things. Simplicity, right? It's driven by corporations and the consumer. And that's it, right? So corporations are either going to have a higher stock price or a lower stock price, and then consumers are either going to spend money or buy things or they're not, which is the cycle and circle of the market and the economy, just to keep it very simple. There's a lot of other variables obviously come into play there. But as Tyler touched on in the last segment was the jobs report came in lower than anticipated, and by quite a big number. So then what we did is the government went ahead and they lowered the future expectations of new jobs. Now, I think it's cool that Tyler pointed out that doesn't mean that there was negative, that we're losing jobs. It just means that their forecast was higher than what actually the reality that happened was. That maybe that's not such a good thing, but being flexible and be able to adjust that forecast, and I think this might have had a powerful impact on the market to why it went up as well. When jobs report came in lower, the market went up. Why? Because they adjusted the numbers for the future growth to be a lower number, which I think is positive. That way these companies realize, gee, we're not shooting for these targets that might not be realistic right now. We got to dial back to really what's happening today. And what's happening today, another point Tyler mentioned, is higher net worth, higher income earners that normally wouldn't have historically shopped at Dollar Tree and Dollar General and Five Below. They are right now in recent history, the last 3 to 6 months, those higher income earners are spending more money at the Dollar Generals, the lower, what people typically would have thought was lower income stores. Well, the positive thing there is they're still spending money. It doesn't say they're not spending money, they're still spending money. And that'll have a positive impact on those types of companies as well. So there's a lot of information. If you think about what is Tyler saying, what does it really mean? I love it. It's awesome. And then Tyler ended with talking about interest rates. Obviously, we all want low interest rates when we borrow money. I want to borrow money for free. I want 2% mortgage. I want 2% on my car loan. I want 2% on my credit cards, right? Well, it's a double-edged sword when we talk about interest rates, because if we're going to get low when we borrow money, then when we invest our money into bonds or CDs or those fixed income investments, instruments like annuities, you might have to settle for a lower return. Who wants to make 0.000 on their CDs again, like we were for years ago? Nobody. When I invest my money, I want to earn 6%. But when I borrow money, I only want to pay 2%. Well, we can't have our cake and eat it too when we talk about interest rate. It is that kind of a balancing act. It's a dual-edged sword. And so, Tyler, I love it that we've talked about the interest rates, the Feds. As you mentioned, Feds very well may. And again, by the time this is being recorded Monday, Feds meet Wednesday. They may, by the time you're seeing or hearing this show, they may have already lowered interest rates, maybe a 0.25%. And we might have 1 or 2 more yet by the end of this year in their November, December meetings. So keep an eye on those things. And then as we have Tyler or another member of his team on our show again as guests, hopefully again in November, December, or when Tyler speaks live at our State of the Market and Economy update here in Midland, first week of October at the H Hotel, he'll bring us up to speed more on what has the Federal Reserve done with interest rates and what does the outlook look like for the rest of the year. Tyler, before we move on to AI, anything else you wanna drop in there on the Feds and interest rates?
No, I think you summed it up well. I mean, not that high income earners are you have to break it out by the cohorts. But they're bargain hunting, right? I mean, that $100,000 to $200,000 are bargain hunting. And that's what you're seeing. In June, the stat that came out was almost 50% of all consumer purchases were done by the top 10% income households, which is income households of over 220,000, right? Which not a lot of people make that kind of money, right? The top 10%. And so that's what we're really watching for, and where the significant impact can have on the market is if that 50% of spending from the top 10, if we start to see, and I don't know if we want to get into tariffs either today, but if we start to see the impact of tariffs on the spending power of that top 10%, and they no longer spend at the rate that they are, that's when you start to see that a decline in the economy, because that's the majority of our spending. And the economy is made up, 70% of it is from consumer spending. So if you see the top 10% pull back on their spending power, that's where we start to look at our portfolios and say, what do we need to do for protection, right?
Yeah, totally makes sense. So you mentioned, go ahead, Tony.
Well, I was going to say, before we get into AI, let's take one last break, and then we can finish. We'll have some time to spend on that. I don't want to interrupt that. So I'm just going to say one more time, we'll give that number. It's 989-835-7203. Call it. You'll get a complimentary, no obligation consultation. You get a copy of Jason's book that he wrote, which is great. Empower Your Retirement. Again, 989-835-7203. All right. So where were we at here? Jason, I didn't mean to interrupt you. We're going to talk about AI next, right?
Hey, no interruption at all, Tony. You run the show, man. We're just here. We wouldn't be here if it wasn't for you, Tony. Tyler and I, we just sit around, wait for you to tell us what to do, when to do it, and then we do our stuff, right? So you control the show, my man, and you're awesome at it. So thank you for keeping control of Tyler and all. Otherwise, we'd just ramble on and go forever, and we'd probably lose listeners and viewers by doing that. So as good as we think we are, but no, this has been a phenomenal show. So we ended that last segment talking about the last 2 segments, really, like talking about interest rates and Federal Reserve. Now, I kind of wanted to slide into the AI topic right now, right? It's a hot topic, AI. But Tyler, you mentioned the T word and tariffs. And I know some people are like, oh, I'm sick of hearing about tariffs. Well, tariffs have a real big deal. When you just mentioned in the last segment there, Tyler, jobs reports, interest rates, higher cohorts spending money, where they're spending, where they're not spending, who's spending. If people aren't spending money or are, there's one of 2 reasons. Number one, prices are too high or don't have the money, right? Or a combination of both. Well, tariffs could have a play on both sides of that coin. So Tyler, I'm going to leave this last 6-8 minutes or so up to you. If you want to go into some of that tariff talk and how that's impacting spending and what we think maybe the last quarter of this year might look like, or let's jump right into AI as well. So stage is yours, my man. Go ahead.
All right. I'll touch on tariffs just a little bit, just because they've come back into the news on a new headline. So the tariffs were deemed illegal by a judge. So now the decision is up to the Supreme Court. They're allowed to stay in place, but we're waiting for the Supreme Court to rule on whether or not the tariffs are legal and if they need to be removed. And the question that I have been tossing around in my head and with some of my colleagues is, what happens if they're deemed illegal? Do we need to pay the tariffs back, the tariff revenue back? So right now we're sitting at about $180 billion that we've gathered this year so far from tariffs. And if we have to pay it back, we're already in a budget deficit. What does that mean for our deficit as well as our budget for this year going forward, as we enter into a season of negotiations between Republicans and Democrats because they need a fiscal spending bill due by October 1st to keep the government running? Right. So all of this is starting to kind of come together and probably likely ahead at some point because it sounds like there will be a government shutdown. That government shutdowns are a non-event for the most part for the stock market.
Right. They happen.
It's short-term noise. If you look at other government shutdowns, the market maybe has a bad week, and then obviously one of the parties figure out a way to put together a budget and everything's a-okay. So that's really a non-event. But what I'm more interested in is if the Supreme Court rules it's illegal and it deemed that we have to pay it back, how do we do that while we're going through these budget negotiations, and who's giving up that $180 billion? Is it the Republicans or the Democrats, and whatever agenda that they want to have? Regardless of what side you voted for, it really doesn't matter to me.
Correct.
But it becomes very important in those budget discussions and how the bill gets passed because it's not a reconciliation process either. They do need the 2/3 vote. So they do need, the Republicans obviously need Democrats to get on to what they want and have some type of negotiating there. So I don't want to get into the politics side because it's really irrelevant to me.
That's neither here nor there, right? Yep, irrelevant.
Yeah. So that's why it's really interesting to me, just because of the timing of it and when the Supreme Court may or may not even hear it. That's a little bit uncertain at this point too. So still to be seen on what happens there, but just thought that was an interesting tidbit to throw out there. But AI. So take a step back a couple weeks ago. We had three very important AI reports. Number one is a company called Nvidia. They make the graphic processing unit that is in most of these AI data centers that are built out with what's called clusters. They had a great report. There's a little bit of uncertainty on their ability to work with China and sell chips to China, just because they were banned for a while, and now it's starting to open up a little bit, but there's still less clarity there. But for here in the US, Nvidia said that companies are spending on AI, and the demand doesn't seem to be slowing down, which is a good thing. The reason I say that, and then I'll get to the other two. The reason I say that is we've had the last 2 years has really been driven by AI companies and really just the biggest companies in the world, right? Your Nvidias, your Microsofts, your Apples to some extent, Amazons, Googles, and you can throw Tesla in there for the Meg 7. Those are the companies that have been driving the market the last 2 years. And yes, there's other companies that have worked, obviously, but really when you look at it from the S&P 500, where has the performance come from? And it has come from those companies.
Sure.
So if you start to see AI demand slow down and that potential return on investment for these companies goes down, what happens to the stocks, right? And if those companies are making up they make up 33% of the S&P 500 right now, which is the US market. If you have 33% of your companies that are no longer going to see this return on investment, they're slowing down their capital spend on it because they don't see it, but they've just wasted all this money, where the stock prices usually go down, and therefore it's going to bring the market down with it. So it was really important for Nvidia to say that demand is continuing. Companies continue to spend on it, right? Especially because they are the largest company in the world.
Mm-hmm.
The second one we got was a different kind of semiconductor company. The company's called Broadcom. They work in a separate, what's called ASICs. They're not the broad-based GPUs that Nvidia creates, but they're like specific task-oriented things. Very powerful, very cost-efficient, and also energy efficient. They reported stellar numbers. I think they reported 63% AI revenue growth on a year-over-year basis, which is incredible for the 8th largest company in the world.
Wow.
And then last week we got Oracle, which for a long time is seen as just this sleepy old company that is kind of in tech. But now they are getting into cloud software, cloud infrastructure. And they saw the quarter itself wasn't that great, but they're projecting that they're going to see 77% revenue growth next year.
Wow.
And
that's crazy.
$18 billion. By 2030, their revenue is going to be $144 billion. In 4 years, you're going to go from 18 to 144. That's a pretty good.
That's a huge jump. That's a big jump.
And the reason I bring those three up is because of how large AI is in the market. And if those companies can continue to deliver this type of growth, regardless of what's happening on the economic front, right? You can have consumer weakness, you can have spending slow down, you can have labor market go down or decline, or unemployment rate go up. With how big these companies are, and if they continue to see this growth, right? You always hear about economy is slowing, so the market needs to go down, and recession concerns, whatever. But as long as these big companies can continue to do what they're doing, that's a good thing for the market. And so regardless of the economic news that you might hear about, the market can continue to, what I would call, grind higher, just slowly step its way up. Yes, there's going to be some volatility, some ups and downs along the way.
Sure. Yeah.
If those companies continue to do what they're doing with the growth that they have, that's great for the market. The ancillary part of that is AI is such a hot topic, and there's a lot of mergers and acquisitions happening. We're seeing some initial public offerings on the stock exchanges again. So one other area of the market that we like, and I would call this a derivative of the AI play, is financials. So a lot of times you might think if consumers are slowing down on taking out loans or credit cards or whatever it might be, why would you buy financials? But I think because of M&A transactions and just the sheer need for loans from corporations to go out and buy these AI companies, or at least spend on AI in some shape or form, is going to be a great for those types of companies. And so, this AI thing is not just good for technology, right? It's good for other areas of the market to give us this broadening out so that we're not driven solely on 7 companies.
Yeah.
So that's why AI is so important right now, and why I wanted to talk about it, because it's a big thing for the market. And regardless of the economic news, the market can still go higher. To what extent, I think I'm not going to say how much, but we think it can go higher from here still.
Wow.
Yeah, that's a big deal. No, I mean, and you're right. You can't turn on any radio station, any TV station, any social media, or talk to anybody at all without some form of AI being involved, right? I mean, think about our cell phones nowadays and our computers, and just everything is AI. Our cars. I mean, it's crazy. And AI, you're right, is not only going to impact the tech sector. Now it does. Obviously, I review a lot of portfolios, and one of the things I look at is how much saturation do investors have per sector. And right now, it's not a big deal to see 20-30% of anybody's portfolio in the tech sector, which is largely driven by AI, right? So that's a good thing. But again, my job as a fiduciary advisor is to help people identify where do you have your current exposure and help you reduce it before we get too much exposure, right? I mean, we want to be diversified, but we want to be careful. If we go all the way back to like the dot-com era, the 1998, 99, 2000, a lot of people got 30, 40, 50% of their money in those areas, those sectors, and exploded. They lost too much of their money. And then we look back at just 2008, 2009, which wasn't that long ago. but the real estate and financials, two biggest sectors that got blown up back then. People had a lot of money in those areas in 2006, 7, and early 08. But if you didn't identify how much money you had or how much exposure you had there, you maybe had too much risk inside your portfolio. So that's why I love hearing from Tyler in the trenches to talk about why are people having so much money right now inside of the tech sector and even financials, because financials is doing well. So to be able to hear from the trenches why that's happening, yes, we want to have opportunity, want exposure on the upside, but we also, from a portfolio manager standpoint, from you guys, Tyler, and then as a fiduciary advisor standpoint, we also want to limit some of that exposure. You just don't want to be the old greedy piggy that goes to the trough all day, every day, because you know what happens to the biggest, heaviest piggy? They're usually the first one to go off the slaughter, and that's not something you or me want for any of our clients. So, Tyler, thank you so much for all your insight. Thank you so much for the resources you provide for myself, my team, the families we serve. Thank you so much for being a guest on our show. I can't wait to see you in a couple weeks here in Midland live at the H Hotel. Listeners, viewers, if you want to come to that event, if you want to see Tyler speak live, have a little dinner on us. It's going to be at the H Hotel, downtown Midland. I believe it's the 8th or 9th of October, but please call my office. They'll let you know when it is. They'll let you know if any seats are available. I do believe we're going to hold a select few seats for radio listeners, for my YouTube viewers. So if you would like to come see Tyler speak live, please give us a call. We'll do everything we can to get you in the door.
All right. Great show, guys. Again, Tyler, thanks for coming. Jason, great show. Listeners, before we go, call 989-835-7203. That's 989-835-7203 to see if there are any seats remaining for that event, or to set up a no-charge, no-obligation consultation with Jason and his team there. And that does it for today's episode of Your Financial Empower Hour with our host, Jason Cryderman.